Hey folks, welcome to another product review at Finominal. Today we're going to look at a product that has managed to increase its assets under management from $50 million as of the end of December to around $3 billion as of March. And that product is BlackRock's U.S. equity factor rotation ETF, which has the ticker DYNF. Now, such rapid growth in AUM is usually only possible if you are as large as BlackRock and you can simply move money from one ETF to the other. So let's find out what makes DYNF special and why BlackRock might have done so. So first thing is we're going to see what the right benchmark for DYNF is. Now, as per the fact sheet, it is the MSCI World, but our performance benchmarking tool does suggest the S&P 500, and we can see the S&P 500 has a higher I-squared, 0.94, than the MSCI World, and has a lower tracking error. So in this analysis, we're going to stick to the S&P 500 as being the right benchmark. We can see from a performance perspective that DYNF has kind of underperformed the S&P 500 throughout most of its period, and it only caught up recently. Next, let's have a look how similar DYNF and the S&P 500 are. We're going to look at effectively the overlap in portfolios. And we're going to use SPY as a proxy for the S&P 500. Now, as we know, the S&P 500 has around about 500 stocks in its portfolio compared to only 73 in DYNF. So DYNF represents a concentrated stock portfolio, which we like because it's difficult to differentiate and create value if you're too diversified. Having said that, from a percentage perspective, there is a 48% overlap in holdings between like in weights, between DYNF and S&P 500. That's high. That roughly translates into an active share of only around 52%, which is low. So we can look at outperformance and alpha later on. Before we do that, we should actually look if DYNF is doing what it's supposed to do, which means rotating amongst equity factors. And for that, we're going to go to our equity factors tool and see if the factor exposures of DYNF are static over time or if they've been fluctuating. And indeed, we see the later, that the fact that betas have been moving around over time. So this is where BlackRock tries to create value by changing its allocations to, for example, the size factor from positive to negative. Same thing for low volatility. Exposure went from positive to negative, while the exposure to quality has slightly increased lately. And the exposure to value momentum seems to have been flat over time. So that's good in the sense that BlackRock is trying to use economic models, whatever way they're timing or allocating to factors. But let's see how effective that has been in terms of generating outperformance. So we're going to use our alpha analyzer for that. And we already saw earlier that the outperformance to the S&P 500 was, well, 0 until today. So since 2019, right, the outperformance has been actually mostly negative throughout the years, except for 2023. Having said that, outperformance is not the same thing as alpha. So the way we define alpha is as the return that is not explained by the stock market or by equity factors. And if you look at that, over the last 5 years or so, the alpha generation was kind of mixed. You had a couple of positive years, but also a couple of negative years. Now, that makes that product slightly less interesting, right? In the sense that, yes, it has rotated amongst factors, but it hasn't found a way to consistently rotate to generate, well, either outperformance or alphas. Now, in case you're looking for other products that provide multi-factor exposure, there's plenty of them. We can use the Fund Explorer for that. So for example, the largest one is OMFL from Invesco, which has around 5 billion. There's also one from John Hancock, around 3-5 billion. And the general problem with most of those products is that as soon as you're focused on US large cap stocks, it's difficult to generate outperformance. I mean, we can demonstrate that by simply comparing DYNF, for example, to OMFL. And we can see effectively that these products, OMFL, OMFL, here we go, are almost identical from performance perspective. And that's probably because here's the chart for that, right? We can see DYNF, right? It has kind of like underperformed OMFL, but recently caught up. Both of them have achieved the same performance as S&P 500, and that's kind of to expect it simply because the S&P 500 is the most competitive part of capital markets globally. These stocks are covered by the largest number of analysts. The way information is being processed is the most efficient, and it's just difficult to create excess returns, even with factor investing, which seems to be the best bet to do so in such a segment. So that's it from our perspective. So if you look at DYNF, right, it does try to create value via factor rotation, which in principle we appreciate because factors have long periods of underperformance. Having said that, it seems to be that the approach that BlackRock has chosen so far has not led to consistent outperformance or alpha generation. And but that's more likely a function of the playing field, i.e. the S&P 500 or the largest stocks globally that are just too competitive to generate extra returns. Hope this was useful. Have a nice day.